Good evening once again. Really nice to have you here. This should be kind of a fun 90-minute engagement with a couple of the preeminent people in the world who deal with money, banking, monetary theory, and the foundation of what economies and civilizations are built around: money. Money, of course, we all have notions about what it is, and it's very surprising or interesting to dig deeper underneath what our preconceived notions about money are, to find out what it really is and where it comes from. So we're going to be talking a little bit about that, because we all are all dependent on it, everyone in the world. And not just money, but also the systems that control the money, and the corporations and the governments that use it to accomplish their means and their intentions for managing all of us, the power of money. Michael Hudson is world-renowned. He's the president of the Institute for the Study of Long-Term Economic Trends. His background goes back 40, 50 years. Wall Street, has a deep background in archaeology, does very unique work in that, and I think left economics to go, well, one way or the other between archaeology and economics. Michael is a unique entity who is a heterodox philosopher and theorist who tells it like it is. Very refreshing to hear him call out people and systems that we've taken for granted in the course of the body politic. He's a research professor of economics at the University of Missouri in Kansas City, a very famous outpost for some great thinkers, and uniquely so. Yeva professor here is from that tradition, is actually one of the students of Michael Hudson and Randall Wray, and a number of other, Bill Black. Great folks who are on the cutting edge of moving our thinking about money, and we'll talk more about why that's important. He's an author of many books. I brought a couple of them. You may or may not see them, but if you see them on the library shelf, by all means, I want to recommend every book I'm showing you tonight. This is called Killing the Host, in which Michael talks about how the current monetary system and financial system is devouring the essence and the core assets of our of our economic system, designed to do that. And the host, by the way, is you and me. Okay, so the financial system is basically devouring us in the process, and that's, of course, its intent, and that's not new. It goes back thousands of years, and Michael can tell you about that too. His latest book is J is for Junk Economics, which is basically a look at how the deception of our common understanding of how money works and banking works is keeping locked in place a system in which we're not able to make much progress in terms of the public interest, that the control is in the hands of a few. So that, and of course tonight's discussion is going to be about the public option in banking, which we'll get into in just a moment. But before we could go on about talking about Michael's career and background, but I think we'll just get into our own interests here. Our other guest is another world-renowned leader in a field of monetary theory and also in banking practice. Ellen Hodgson Brown wrote this book called The Public Bank Solution, which was predated by the bestseller Web of Debt, which really precipitated a new national movement to create public banks. Public banks being banks that are owned by the people, they are the shareholders, the stakeholders, and they are the recipients, the beneficiaries of how the public bank operates. When we talk about public banks, we refer to the Bank of North Dakota, which is the only one in the United States. But they're all over the world, and they have powered much of the most powerful economies in the world: Japan, China, Germany, Brazil, India, Russia. These are all, and Canada, nominally anymore. These are banks that are owned by the people. And what Ellen will undoubtedly tell you in just a couple of minutes is that what banks do is a very important thing. They create money. Now, some of you might think that money is a limited commodity that's a little like, gold or some other sort of finite entity of limited resource, but it's actually much more flexible than that. And we are now in discussing the public bank option. We're talking about literally a new day in how we understand our relationship to the creation of money. If politics, and it does, if politics is run by the people who have the money, and it's been like that for thousands of years, then if the people have the money, then public policy can start to reflect the interests of the people who have the power. So the whole idea about public banking is that we start to create a systemic institutional shift away from the oligarchic control behind this mystical curtain of who creates money and who's in charge, and put it into the hands of the people so that we can start to get some of the stuff done that we want to get done that we can't afford, okay? Like infrastructure, like educating our students, like preserving the environment, and a host of other things that you know very well. So this is one of those moments in history where something is emerging in America that actually emerged 100 years ago, actually hundreds of years ago, but most recently 100 years ago, when the Bank of North Dakota, as a response to the public dynamism of the populist urge to want to try to take on the monopolists in the upper Midwest, to be able to cut themselves a fair deal against the people who were stealing their crops, basically undercutting their transportation, fixing the markets so that people were losing their assets. Well, if you look around America today, you see that now. You see millions of people have lost their homes, and that's not an accident. It's symptomatic of the way the financial system is operated. Now, I've said enough. I think it's in time to turn it over to, well, let's see, B before H. We'll start with Ellen Brown. Ellen, let me just leave that open question to you. What is money, and where does it come from?
Okay. Does that work? Hello? Okay. I'll say what public banking is basically about returning the power to create money to the people. Most people think money is created by the government. It's not. It's created by banks when they make loans. That used to be conspiracy theory until, well, in 2014, the Bank of England actually came out and said it in their quarterly report. They said, contrary to popular belief, banks do not lend their deposits. They actually create deposits when they make loans. And the Bank of England said 97% of the UK money supply is created in this way. So, how do we get that power back? First of all, how do we lose it? The American colonists created their own money, and this was a brilliant system that was remarked on in Europe, that these colonists were able to be so productive in the wilderness. I mean, they didn't seem to have much to work with, and they had a vibrant economy. They did it by issuing their own money. Until King George said that they couldn't do it, which caused a great collapse of the currency, because they didn't have much in the way of gold, and they didn't have banks to borrow from. So, and their own money supply collapsed. So they rebelled. They went back to issuing their own money. That was considered an act of rebellion, which triggered, or at least was one of the triggers of the American Revolution. So they fought this revolution without any money, basically. Benjamin Franklin remarked how amazing it was that they could win a revolution or a war against the world superpower at the time just by issuing their own money. But the problem was that by the end of the war, the currency was worth virtually nothing, largely because the British were counterfeiting it. But anyway, the Founding Fathers then were so afraid of paper money that they were afraid to put it in the Constitution, or they couldn't agree on whether to give Congress the power to issue money. And so the Constitution says only Congress shall have the power to coin money and regulate the value thereof. So coins were originally the legal tender of the country. But the problem was that you couldn't really have a vibrant economy or you couldn't have a growing economy without a growing money supply. And so the banks filled the breach with their banknotes, which were basically just promissory notes for gold. It was, had the name of the bank on it. It was a private banknote for gold. But they, on the fractional reserve system, they issued 10 times as many notes as they had gold, or up to 10 times as many, because they knew that people only came for their gold 10% of the time on average. But the problem was that, periodically people would get wise to this, or there would be runs in the banks on average every 6 years all the way through the 19th century. So and then in the 1860s, but by mid-century, coins were half the currency and the other half was bank-created money. And then in the 1860s, Abraham Lincoln went back to the system of the American colonists and just issued greenbacks, which worked very well at the time. He managed to win the Civil War, and the greenbacks funded a great deal of development, including the Transcontinental Railroad and the charter college system. And in the National Bank Act of that period, the states were, the idea was to get these private state banks to join the national banking system. So they were taxed 10% on the banknotes. So they quit, and those that didn't join the national banking system got around this tax by just writing into people's accounts their loans. Instead of lending them these paper banknotes, they would just write the sum into your checkbook. And so you essentially are creating the money yourself by writing these checks. So that's the system we have today, where virtually all of our money is created by banks in the form of this checkbook money. So how can we get that power back? That's what we're all about in public banking. You could arguably, Congress could take the power back. They could do what Abraham Lincoln did, but that's not too likely. The Federal Reserve could do it by some sort of quantitative easing that actually jumps the great divide between the reserve accounts and the money circulating in the money supply, and actually get money out there. For example, they're doing a basic income guarantee or quantitative easing for infrastructure, or for healthcare, a number of things you could use that for, also not too likely. Or we, the people, can take back the power at a local level by forming our own publicly owned banks on the model of the Bank of North Dakota, which is our one and only model at the moment, and do like all banks do, issue 10 times as much credit as we have in capital. In other words, if you take, say you've got $1 billion, like I'm from California, so our pension funds have $500 billion in them. So if you took $1 billion, which the pension funds would barely notice, you could capitalize your bank with that. Then that allows you to lend up to 10 times that sum in credit. So you're basically creating 10 times what you started, 10 times that $1 billion. Of course, you need the 10 billion in deposits, but you can pull those deposits out of Wall Street or wherever they are now. This is your own publicly owned money, and put it in your own bank, leverage it. Instead of having a revolving fund where you're just lending out, taking the billion, lend it out, you can lend out 10 times that amount, and that's what we're all about.
Yeah, Ellen, I just want to interject here that there's the key point of what she's talking about is that banks, make money, and when you can multiply what you have tenfold. I mean, they got away with this in a historical way. I mean, you could talk about the gold merchants and so forth, but that's really the tool that we're talking about when we talk about a public banking franchise, right? Yeah. Yeah. Well, Michael, banking used to be a relationship between people to extend credit that was within small confines, and it's become something quite different now, hasn't it?
Yes, if you look in the textbooks that you're given, not here at this university, but in most money and banking textbooks throughout the country, you have a little picture, and it's about a factory and a bank and workers. The bank is making a loan to the factory buys some equipment, the equipment hires labor, and you have the happy workers walking with lunch pails into the banks, and it's supposed to be the circular flow that banks finance growth. That's not what banks do. Banks don't lend to create new means of production. That's supposed to be the stock market or private capital. Banks only lend against property that's already in place. 80% of bank loans are mortgages to real estate. And the reason real estate prices have been going up throughout the whole country is a property and a house is worth however much a bank is going to lend against it. So let's look back 8 years ago when you had Citibank, the most reckless bank in the country, making essentially junk mortgage loans. The bank was basically, as Bill Black of the University of Missouri has described, a criminal enterprise. The first thing you do, if you see the old movies of the 1930s, you know that the first thing that the crooked little film noir towns they have in the South, you'll have a local crook, and he's going to have a family member being the head of the police. He's going to want to have a nephew who's a judge. You want to make it sure that there's not going to be any prosecution of what you do. Well, Citibank hired Robert Rubin, who was a Treasury Secretary, who moved from Wall Street at a huge salary, and his job was to protect Citibank from prosecution. So Citibank embarked on the largest fraud wave in American history. And the vocabulary all of a sudden expanded the English language. For instance, junk mortgages was a new word in the language, a mortgage that you make to a ninja borrower, no income, no job, and no asset. So the banks would say, we'll just make you any big loan you want, $1 million for a $20,000 house. They'd make, the buyer would go into the bank, he'd sign an IOU, the bank would put $1 million in his account, and so you'd have $1 million new money that's created. You usually had to be a friend of the bank, not a family member, but part of the same gang. And the bank would then have $1 million mortgage. What are they going to do with it? They're going to find someone really dumb, like a German savings bank that trusts the Americans, or a pension fund that you take out for a big party and stuff it. Well, in 2008, the whole thing came down, and you had Citibank wiped out. No net worth at all. All the net worth, all the capital that it had, all the stockholder equity was all wiped out by the junk mortgages that it made and their crooked loans. So you had the head of the Federal Deposit Insurance Corporation that insures all the banks, Sheila Bair, write in her autobiography, she wanted to take it over and say, look, get the crooks out. Well, immediately, President Obama said, wait a minute, my Treasury Secretary works for the head of Citibank, and he's their bag man. He's the job to be here to make sure that nobody's thrown in jail, and I've just appointed an attorney general that's never going to throw a banker in jail because some of them have innocent children and wives, and we don't want them to be hurt. So, although he didn't mind their kicking 10 million American families out of the houses that they had. So basically, they blocked the FDIC from taking over Citibank. But just imagine if the government would have done what it could have done. Here's an insolvent bank run by crooks. Imagine if the government would have taken that over. It could have made honest loans to people who don't default. It could have given you credit cards at much lower credit card rates at the actual price that it costs to make credit cards. They wouldn't have had to pay 29% interest. They wouldn't have had to make corporate leveraged buyouts to corporate raiders who come in and close factories down. So the picture of banks making loans to companies, they don't loan to companies, they loan to the corporate raiders who buy the companies, lay off the workers, loot the pension funds, smash the company up and take the money and run. Somehow that didn't get into the textbooks, but that's really what has become. The banking system in this country has become a travesty of the textbooks, and it's become basically a ripoff exercise. So you'd think that this is so obvious to people with the new words added to the language. People, in 2009 or 10, the Financial Times had a list of the 8 people who'd forecast the crisis to the month, and I was one of the 8. And people said, gee, that's amazing. You know, you forecast it. And that's pretty, the fact is, everybody knew it was going to crash. Thousands of people knew it would crash. They had this movie that they made recently about the guy who was able to bet against the market. I mean, if they would have lent me $1 billion, I would have bet against the market, but I wasn't part of the club to do that. But the fact is, if you have all of the newspapers referring to junk mortgages, the newspapers referring to ninja loans, they all knew that it was crooked, but they thought they could get the money out in time, and they weren't able to. Now, why isn't this in the textbooks? And the reason's quite simple. The commercial banks that are run by simply writing a loan and then charging you interest for something they just do on a computer keyboard. The government can do this on a computer keyboard. It doesn't cost any more money than the electricity costs to run the computer. The banks don't want a discussion of public banking because they don't want the competition. So what I've been told for 50 years, whether it's in Canada or in Germany, they say, oh, if the government creates money, it's going to be inflationary. But that's a myth. It's what psychologists call an implanted memory. You think that it was the banks that somehow lent money to Germany to create the hyperinflation of the 1920s, but every hyperinflation of every country in history, except Zimbabwe, has come from having to pay foreign debt and just print the money to throw onto the foreign exchange market to collapse the currency. So the banks have subsidized a kind of junk economics, a false picture of how banking works, and the textbooks in most of the money and banking courses throughout the country are written by bank lobbyists to make banking appear only to do good things, to make loans that make everybody rich, that don't result in 2008, that don't lead the economy bankrupt, that don't lead to 10 million home foreclosures. None of this reality economics appears in most of the textbooks, and the mass media pick all of this up. And you have economists who are so ignorant of banking that they're the ones that bankers applaud. People like Paul Krugman, who thinks that banks actually are savings banks and doesn't understand that banks do what Ellen understands, that they write a loan, they create a deposit. He said that's impossible. And he got in any of you who are interested can read his debate with Steve Keen, K-E-E-N, an Australian mathematician who was the first person that Krugman ever was deigned to actually mention his name. And if you like the movie Bambi Meets Godzilla, read that debate and you'll see, what happens when you have reality economics confront the bank lobbyists' we call them, what did we call them? Learned ignorance.
Oh, no, institutionalized deception.
Institutionalized deception. I love that word.
Yeah, that's
institutionalized deception.
That's my phrase there. So Michael's describing this rather, shocking perhaps, and certainly very troubling reality of how our money and our money system is working. And another word for what has happened is that the banking industry has become financialized. Financialization is the term. Financialization is exactly as he described. It's using the assets of others to build the profit margins and the profit ledgers of those who have the money to participate. Instead of putting it into the economy to build schools and all of that. Now, when we talk about banking, I'd like to make a distinction here, especially relative to the public bank option. We don't mean to be casting the whole banking industry into the can. There's the Wall Street investment banking category, and that's a business like any other profit-making business. It has its pluses and its minuses. But what we're talking about, the banking that we really want to stand with and really reinforce is community banking and credit unions, the local financial institutions that actually do the good old, what they call good old boring banking, where they'll give money to people to do something like build a house or start a business or go to school, you know, all the things that people need money for, because money is a utility. And that's one of the things that Ellen has really brought forward, is a distinction between the way we've been thinking about money as a commodity of limited and transcendent value that we want to pursue and acquire and collect as much of as possible. In fact, each one of us lives in this web of debt where we trade our time, our lives, our vitality to be able to pay off the debts that we all have acquired. Now, everybody needs money. Ellen, if you illustrate that the government can create the money that we need, and you've given some examples. You know, you're all familiar with the need for infrastructure and the conversation now about public-private partnerships on how money is being pursued, $1 trillion for infrastructure. That's a fraction of what's needed. The idea, what the Washington agenda now is to bring in private parties to help to provide some of that cash. Ellen's position is that we can make it up, and there are some pretty strong historical examples of that. Why does the government not have to pay back the money that it, quote unquote, creates, that it borrows?
Well, I get in trouble for pursuing that line.
No.
I'm not allowed to say debt-free money. There's no such thing as debt-free money.
Well, here's a better framing. I mean, we are all talking about, everybody's told about the national debt, you know, the debt ceiling, and that we've got this $20 trillion debt. Aren't we in deep trouble? Our generations of people, y'all, will be paying it back. And that's really a bogus, it's a boogeyman that they use to keep the people from realizing what's really going on, which is that, you know, we have a different sort of a power capability.
Yeah. Okay. So we have a $20 trillion debt now. So we've hit the debt ceiling once again on March 15th, or they reactivated the debt ceiling. So they can't lend. They can't go further into debt without getting the approval of Congress, and you know there's going to be a fight over that, like there always is. But what they could do, there's actually, we've seen with quantitative easing has thrown a totally different light on people's understanding of what money is and what can be done with it. The fact that the Federal Reserve
What is quantitative easing? I'm not sure that they would know. Quantitative easing being the creation of new money, right?
Well, you want to say?
It's when the Federal Reserve creates reserves for the banks, that the banks then meet their capital requirements and are able to make huge loans. It enables banks to make money to corporate raiders and to speculators and to the real estate developers. They have no intention of lending the money into the economy or spending it on anything that has to do with employment. It makes it cheaper to buy and to borrow from a bank at 1 or 2%. And buy a stock yielding 9% and just get a free ride off the arbitrage, the difference between what you can make and what the Federal Reserve charges. So the Federal Reserve did this to let the banks, it said, we have two choices. Either we can save the economy or we can save the banks. And President Obama said, save my constituency, my donor class, save Wall Street. And they saved the banks, they left the debts in place, and so the Federal Reserve said, wait a minute, the banks are all broke. What do? We're going to give them $4.3 trillion of free money to gamble with and let them gamble and earn the money back. So they gambled, and they've been either earning the money back but taking huge risks that nobody really knows about. So either they've gambled their way out of debt and by playing the lottery, or against the pension funds and against mutual funds, or there's going to be a big boom.
Okay. Well, okay. To start with, we had TARP, which is what Congress, or what Congress did. And then the Federal Reserve stepped in and did something similar to TARP, where they bought the toxic assets off the books of the banks. That was QE1. And then
Listen to that, toxic assets. That was a word that already existed in 2008. If the word is in the vocabulary, toxic assets, that means fraud. That means the banks say the properties and a debt is worth something and it's not worth anything at all. This is con job. That's what she's talking about.
Okay.
Well,
So Nancy Pelosi at the time said, "Oh, we didn't know you had that kind of money," and whoever she was talking to said, "Oh yeah, we got it, and we got a lot more." And it turned out they had 16 trillion, or 26 or 29 trillion. It's depending on how you count it. They had a lot more, which reminds me of apparently when Roosevelt took the dollar off the gold standard. Somebody said, "Oh, we didn't know you could do that," but obviously he did it. And when Lincoln printed greenbacks, Lincoln said that somebody advised them that he could do that. He could just issue the money. And he said he didn't know he could do that. So the point is we could do something totally different than what's being done now. And we've seen with what the Federal Reserve is doing that there's some pretty creative things you can do. So the Federal Reserve already holds, is it 3.7 trillion in federal securities, or maybe that's all there? I forget. Sorry?
Probably about 2 trillion of mortgage back.
So is it 1.7 in interest, 1.7 trillion in federal securities? So they own all this debt, which is one agency of the government holding the debt of another agency of the government. The Federal Reserve rebates the interest to the Treasury, so the Treasury gets that money back. So it's basically interest-free, but it's sitting on the books of the Fed as if we owe this debt, which is like this ceiling over Congress, so they can't issue more money, which means they have to sell off public assets and privatize everything, which obviously serves the big money and the big investors. But what we could do is just write that debt off, because if the interest is being returned to the government and the debt can just be rolled over from year to year, or it just sits there on the books, it's effectively nothing's happening there. And it didn't create inflation, as everybody thought it would. So we could write off the entire debt and it wouldn't create inflation. It's just this thing that hangs over our head and we have to pay interest on it. It's the interest that's really a problem. If you didn't have to pay the interest, if you took over all that debt by the Federal Reserve, then you could just write the whole thing off.
So what you're talking about is sovereign money. And it is the first right of any a nation, a sovereign nation, to create its own currency and its own medium of exchange. That's our right as Americans. We create our money, which is why we're not limited by it, because as the Constitution says, you will not challenge the debt, the balance is unchallengeable. We will pay all of our debts. That's not a question. So we're good for our money, and we can create it when we need it. Now, going back to the public banking option, let's take a look at what that looks like in North Dakota. We talked about the 2008 collapse, in which the global banking cartels failed out of the house of cards that they had built on the derivatives and swaps and the whole kinds of financial paper that they lay out and sell to us, including, by the way, and this is a really important point, the municipalities, the cities, the counties, and the states, they sell this product to the tune of $4 trillion of our money that's being held in private banking institutions. Now, they're doing us a favor. They're giving us the money. That's the idea. That's only because we didn't know that we could create the money ourselves, okay? So what does it look like in the public bank option? In North Dakota, in 2008, there was a really unusual event. They had the biggest budget surplus they had ever had. They were the only state out of 50 that had it was in the black. They had no impact from the collapse of the global cartel. And the reason is, and this is meant to be emblematic of what difference a public bank could make for us on a state level, in a city, and a county level, is that they had the Bank of North Dakota. So they were able to issue their own credit, to finance them, to support their local economy by themselves without any influence of New York, without having to borrow. They have, it's a small little state. So they got 700,000 people. They got a $7.3 billion bank. And every year that little bank spins off, in the last year, I guess it was about $100 million that goes into the state treasury just by doing the business of banking. So the public bank then does a number of things. And talking about infrastructure, give them an example of what funding infrastructure in North Dakota looks like.
Well, no, they are now making 2% loans for infrastructure for local communities. So in other states, infrastructure bonds are 4 to 6%. So the local community is getting their infrastructure for basically half price or less. But that 2% then is going back to the state. So the state itself also gets the money back. So the people themselves get the money back. Now, you said that the Bank of North Dakota is not, or they're not borrowing outside, but they actually are. The thing is, they are getting the perks of a bank. So they could borrow from the Federal Reserve. In fact, I think they mostly borrow from the Federal Home Loan Banks, which is this big network of banks that virtually all banks belong to. So that they, like all banks, they are getting to leverage their fund, or to arbitrage. So they borrow very cheaply, and then they can lend for the purposes of the community, and the profits go back to the community. So.
And what you're illustrating there is that in banking you need to have a deposit base to be able to satisfy the loans that you've made. Is that if they don't have it in the vault, so to speak, what they can do is borrow it like the big banks do at the Fed window at 0.25, 0.5% interest, and then they put it on the market and make the spread between 3, 5, or if you're on a credit card, 29% interest, and that's why banking is so profitable. Yeah.
Yeah. Well, and the Bank of North Dakota serves the function of a mini Fed for the state. So they're making, they're doing the liquidity for all the local banks.
Yeah.
So
Michael,
need these lines of credit.
So Michael, in the scheme of banking and what the public option is proposing, how do you think we're going to get past the 8,000-pound gorilla that sucks up the oxygen of our economy?
It's, you have to realize that the economy has not grown since 2008. The banks had created such a mess by the bad loans that the economy now has to work to pay it off. And the government is really running all the American policy to find a way to channel more and more money into the bank so that they don't go bankrupt and continue to make profits of 12 or whatever they make per year. I'll give you an example. Right now, the gross domestic product of America and other countries is growing by about 2% a year. The amount of debt in most countries is equal to 100% of GDP or more. But the average interest rate on this debt is about 5%. So just think to yourself, if the economy is growing at 2%, but the interest on loan is 5%, then the rest of the economy has to shrink and ends up shrinking and actually loses 3% per year just so that the banks can be paid the interest. Now, this is what's happened since 2008. The gross domestic product has gone up a little bit, but all of the growth in gross domestic product in America has gone to only 5% of the population. And that 5% is basically the richest 1%, the financial sector, Wall Street. 95% of the population are worse off now than they were in 2008. That's why you had the last election returns that you had. So if you leave the debts in place the way they are, the American economy is going to end up looking like what you read in the newspapers about Greece or Latvia or Argentina or other countries that are subject to debt deflation. Now, 80 years ago in the 1930s, there were articles on debt deflation and everybody was talking about debt deflation. The pretense is that debt somehow helps the economy grow. instead of shrink. Now, when Ellen talks about what the Bank of North Dakota does, she's talking about bank lending that actually is productive and helps the economy grow. But that's not what commercial banks do. The private banks aren't interested in helping the economy grow. They're interested in just ripping it off and causing results that lead it to shrink. So really, the choice between public and private banking is not only between honest and dishonest banking, it's between productive lending and unproductive lending. And these are the concepts that have to be popularized for people to understand why the banking system has become so dysfunctional and gone so wrong.
So just to illustrate that in terms of the needs of people to borrow for, say, small business, large banks, as Michael illustrated, are not terribly interested in making loans to risky new business people who are trying to build a business. And that, of course, the first 5 years of business are, you have a good chance of not making it. So they don't make those loans. Community banks make those loans if they are supported, and if you are a credible person, you have a good business plan, you can perhaps get a loan from the community bank. At least you're more likely to get one there than you are from one of the big banks. So in North Dakota, how they serve that market is that they partner with the community banks. And by the way, I need to kind of parenthetically state that the public bank that we envision does not do direct lending to citizens, at least not in the North Dakota model. It supports the community banks and the credit unions in making loans into the community that they know and that they have an investment in themselves. So the public bank then reinforces a very important institutional part of the system of local economy by being able to support local banks and succeeding. And so as a result, there are more community banks and credit unions per capita in North Dakota than anywhere else. And by the way, they make 3 to 4 times as much money. Everywhere else in the country, they're going away. Michael illustrates an environment that you all are inheriting, in which a massive financial system is really running roughshod over your interests, and that you are losing ground in terms of having any way, any ability to recapture it. The public banking option really provides a breakthrough opportunity for the citizens of America to execute some democratic influence and impact on who controls the money and how they can make it work for themselves.
We should probably talk about how the Bank of North Dakota works.
Please.
By law, all of this, the Bank of North Dakota was formed in 1919 when the farmers were losing their farms to big out-of-state banks, and so they formed a populist movement, managed to win an election, set up their own bank, and set up their own granary. So by law, all of the state's revenues are deposited in the bank. So it has a massive captive deposit base, so it doesn't have to compete with the local banks for deposits. It's got a massive capital base that is built up over 100 years. But besides that, it was set up as North Dakota doing business as the Bank of North Dakota. So technically, all of the assets of the state are the assets of the bank. So it's not competing for money or business with the local banks. The local banks act as the front office. So they go out and, for the most part, find the loans. I think the Bank of North Dakota does make direct loans, like they make 1% loans to startup farms, startup businesses. They have certain sectors that they support. I saw they made a 1% loan to build a school in California. Orange County school districts are so strapped for funds. They have a debt ceiling. They can't go further into debt, and so they've actually fallen for these capital appreciation bonds that go up as high as 1,500% over 40 years. Like they're like subprime loans for school districts. So in North Dakota, you don't have that problem because the Bank of North Dakota makes these loans. That's one of the sectors they support. There was a study that came out of the Wall Street Journal, or it was an article in the fall of 2014 that said that the Bank of North Dakota was more profitable than Goldman Sachs and J.P. Morgan Chase, 70% higher return on equity than those two major banks. And how did they do it? Well, this article said it was about oil, but in fact, at that, the oil boom did not hit until 2010, and the Bank of North Dakota was already the only state that escaped a credit crisis in 2008, and the Bank of North Dakota was already doing brilliantly well then. And there was 2 years of an oil collapse after that, and still every year the Bank of North Dakota has reported record profits greater than the last. So it's really their business model. They don't pay bonuses, fees, or commissions. They don't have high-paid CEOs. They don't have shareholders sucking, or private shareholders sucking the profits out. They don't advertise. They don't have. They have 2 branches, but it's not like an ordinary bank that has to have a branch in every little town. They don't have to worry about tellers and staff hardly at all. I mean, they're basically an accounting function. You could just have a few people sitting in an office and do this. In fact, that's what we're trying to do in California, is to get the iBank that we already have to turn into a depository bank, or be turned into a depository bank, so it can leverage its money the way depository banks do.
Yeah, so they have the student loans, 1.75%. I don't know how that fits with y'all. Maybe you're not facing them just yet, but that sort of people-oriented lending is really key. Well, Michael, around the world, public banks have had a pretty stellar sort of a history. Germany, the Sparkassen, an example that we like to use.
Well, or in Canada in the 1930s, the Bank of Canada was simply creating money, and they financed infrastructure by simply printing the money. Now, you could have gone to a bank that would have created money and charged interest and insisted that the infrastructure, the roads or the transportation be charged at a very high price. But when the government finances infrastructure, it wanted to build roads that people wouldn't have to pay for, and water systems that people wouldn't have to pay for. So they were able to create inexpensive infrastructure for the economy. The way the plans now are for how American infrastructure is being financed is it's going to be very high-priced, and so high-priced that it's almost impossible to imagine how America could become an industrial manufacturing power again if the price of housing is so high. In New York City, where I live, the average rent is $4,500 a month. You can imagine the average American homeowner having to pay between 30 and 40% of their income for rent, 15% for the FICA, the wage withholding from your paycheck, about 10% for credit card, student debt, other kinds of debt, and about 15 to 20% for taxes. The average American family can only spend between 25 and 30% of their paycheck on goods and services that they produce. So the economy is shrinking and shrinking. They don't have enough money to buy what they produce, so the market here is shrinking. This doesn't exist in China. China is the example I think you're looking for, a mixed economy where the Chinese central bank will decide who to extend the credit to, and if it extends credit to a company that suddenly finds itself in a depression like happened in 1997 throughout Asia, the Korean companies that were and other near Far Eastern countries that were broke had to sell out to foreign investors because they were broke and had to pay the debts. But China can, because the debts are owed to the Chinese government and the banks, it's easy to cancel debts when you're canceling debts owed to yourself. So China decided not to bankrupt its industries, and that's why its economy can continue to function while Europe is in a just austerity, debt deflation, shrinking, emigration, and you can read about it in every story about Greece that you see, which is the poster child for austerity and for the bank's neoliberal model.
Which is an unfortunate example of how powerless the democratic system can be in the face of the financialists who run and own the show. Michael had the pleasure, I presume, maybe the challenge of working with the Greek government, with Yanis Varoufakis, the finance minister, back when Syriza, the progressives that took over the country, as they were facing an onerous debt from the Troika, the European Central Bank, the International Monetary Fund, and the EU. They had forced the country into debt. They couldn't pay it, so they said, and they wouldn't make a deal. And so what they did is they're coming after the assets. And this in Greece, okay? So the ports and the beaches and the resorts, all the stuff that the people owned, they're coming after to pay the debt to the hedge funds and to the financialists that are looking to cash in. And this is true in Puerto Rico, in Argentina, and of course we see it true in America, don't we? We see people who have 10 millions in Chicago. Well, and so all over. And I think that I hope this isn't too dark for you guys, this portrayal here, because if anything, we would suggest that the public option in banking is a bright light that's shining through the darkness of the regime that we're currently overwhelmed by. And I think, and what we know is, as George Carlin would say, is we know what they want. They want more for themselves and less for everybody else, and they'll get it. And so it is this really a great American struggle that has come back around into this country. I'm going to just give you a brief update, and then we're going to go to some questions, because I think it's about that time, unless you have more to add. But around the country in the United States, we have over 50 different cities and counties and states that are working on creating a new public bank. We have here in Pennsylvania, the governor's office is even looking at it. The city of Philadelphia is actively addressing whether or not they can have a public bank. The legislature in Massachusetts is now looking at an infrastructure bank. We're doing the same sort of thing in California. The state legislatures of New Hampshire and Maine, Vermont, Arizona, New Mexico, Washington State, and elsewhere, all over the country, this opportunity is coming forward. And I think it's really important that y'all get in touch with it and pay attention to it, because it's going to need your support. People don't typically want to touch the unknown mystery of the banking industry. It has been portrayed and obfuscated in all kinds of curious ways to keep us from understanding how simple it is. But the issuing of money and credit is an essential utility. It belongs to all of us. The public banking option becomes a very exciting way for us to re-democratize our institutions of finance and of public interest. Any more comments that you'd like to make right now, and before we turn it over to other folks?
I think the slogan for our talk would be, if you don't own the banks will own you.
All right, any thoughts, any questions from you all? We can certainly go on, and we will. Yes, John.
One of the things that we have constantly heard from the Peterson Institute and every member of Congress and the President is that we're essentially out of money. We can't afford it. The debt we have is going to crush our children, our grandchildren. And my question is, when will that happen?
Adam Smith wrote that over 200 years ago that no country has ever repaid its debt. The national debt is something that doesn't expect to be repaid. You can look at every country in the world and you can see the debt going way, way up. There was a time in the around 1890s when America almost paid off all of its debt. It took it 20 years to repay the debt that it ran into under the greenbacks, and that caused a chronic depression, foreclosures. It caused a crisis in America. There was a miniature version of that time under the bank candidate, Bill Clinton, who actually ran a budget surplus in the late 1990s. And what happens when you run a budget surplus and actually try to pay the debt? Well, all of a sudden, running a budget surplus means you suck money out of the economy. You tax more than you spend. You retire the debt, and by sucking it out, it's the banker's dream. The only way the economy survives is people have to go to the banks to get the money that the government is not providing. So running a in the rare time that America tries to pay down the debt, it causes a deflation, it causes unemployment, it causes foreclosures and economic collapse. Countries aren't supposed to repay their sovereign debt. America has no intention at all of repaying its debt. If any country, I think once in a while some joker would come and say, here's a $100 bill, pay back the debt, and the Treasury will give it 5 $20 bills. But the governments aren't supposed to pay the debt. The debt that they run is what supplies the economy with money.
How about a debt jubilee?
That is one way or another, the debts can't be paid. And there are two ways of not paying the debt. One is to leave the debts in place, as was done in 2008, and that means a slow crash. Down and down, it means foreclosures. In the end, the debts have to be written off. And that's what I was trying to urge Syriza to do in Greece. Simply don't pay. Refuse to pay, and we wanted let the Eurozone expel us. We're not going to resign if the Eurozone will take it out on the banks, and the banks were how the oligarchy in Greece had. So I don't know if you've seen the movie Z about the colonels, but these were the oligarchs who were supported by the colonels and essentially by the Nazi regimes that were put after World War II that were put in place by Truman and Britain, as opposed to the anti-Nazis who were the communists. So basically, if you don't write down the debts, then you're going to have mass poverty. This is what the Jubilee year in the Bible was all about. And that practice, people say, oh, it couldn't have happened, but it did happen again and again and again and again. For 2,000 years, every new ruler of Sumer and Babylonia, upon taking the throne, would annul not the business debts, but annul all the personal debts, all the unproductive debts, and start the new reign with a clean slate. Not only that, he would free the bond servants, debtors who had had to work as bond servants to their creditors, and he would return all of the lands that had been forfeited. So this was normal. All of Hammurabi's dynasty proclaimed clean slates. The words the Babylonians used was andurarum, which was cognate to the Hebrew word duror, which was used in Leviticus 25 for the Jubilee year. And when Jesus opened, the first speech he gave, when he returned to his hometown and went to the synagogue, unrolled the scroll of Isaiah and said he'd come to proclaim a clean slate. The Bible doesn't say a clean slate, because when it was translated into English, they didn't know what the words meant. The year of the Lord, these were the words, all the code word, and the word gospel means good news. The good news meant clean slate. But in the 18th century and 17th century, the translators of the Bible didn't know cuneiform at that time, which wasn't translated until the 19th century. So only now do we understand that the whole Near East functioned for 2,000 years, wiping out the debts, and that could be done when the debts were owed to the government. The rulers, the palace who was canceling the debts, were basically canceling debts that were owed to themselves, to the temples they controlled, and to the collectors in the royal bureaucracy. Well, today, the debts, only China can annul the debts that are owed to itself. The United States government can't annul debts owed to Wall Street because Wall Street runs the government. So that basically is the dilemma that we're in. We need a clean slate. Absolutely right. And without a clean slate, the economy is going to continue to shrink in a slow crash.
But how do you propose to get there?
What?
How do you propose to get there if we don't own the banks? We have to.
That'll take a little while to do. It may take a little bit of fighting.
So why didn't Greece buy your suggestions?
Well, the reason that Varoufakis quit the day after the referendum, Tsipras had expected to lose the referendum and thought that the Greek people would say, oh no, stay in the common market no matter what. And Tsipras decided that he wanted to remain in power no matter what. He was a politician, it turned out, and even he wanted to be the guy in power, even overseeing the destruction. So Varoufakis quit the government, and Jamie Galbraith went back to, his advisor went back to Austin, Texas, and the Syriza people fell into a depression, and now he couldn't be reelected if there was an election, so he ended up in a shameful fashion.
I'd like, before we get to Tom, I just want to throw in one example that might be useful that of a jubilee that we think is completely available that we've talked about, and that is a student debt jubilee. You know, to create $1.4 trillion on a ledger and get you all out of the prison of having to pay, get out of school and then pay decades of debt. Unnecessary, debilitating. That's one of the ways in which the mindset, the consciousness of your consciousness about how money works and banking works can insist and inform your representatives to get on with this work. Tom.
Michael, with Lincoln, it seemed, just spent money with the greenbacks to make things happen, to create the railroads. And I read somewhere where Milton Friedman said we ought to be spending 4% of GDP, just spend it into the economy to get things done. The concern people express is inflation. If we did that and we caused inflation, how would you deal with it?
Well, there wouldn't cause inflation. The whole 18th century monetary theory, David Hume, everybody realizes that when there's underemployment, it's not inflationary, that you need money in order to lower prices. You need money to finance new investment, to introduce new productivity, to cut costs, when there's unemployment, as there is today, to increase the money supply, there's no price inflation. We've had, Ellen mentioned, the $4.3 trillion created by the Federal Reserve. All of this has gone into Wall Street. It's inflated stock market prices, it's inflated bond prices, but not consumer prices at all.
I'd like you to follow up on my original question by perhaps briefly describing why, when the government runs a surplus, it creates real problems down the road with recessions or depressions, by briefly explaining sectoral balances.
Well, how does a government run a surplus? It uses money to buy back the bonds. It doesn't print more bonds to buy back the bonds. It has to tax. So you run a surplus by increasing taxes on the economy. And who are they going to tax? Wall Street doesn't want to be taxed. The largest sector, real estate, doesn't pay tax. The oil and gas industry doesn't pay. It's basically wage earners pay the tax. And so they they pay off the debt by taxing labor more and making it even more uncompetitive in world markets and shrinking the economy all the more, making it running an even bigger deficit. All these plans for austerity that the International Monetary Fund has imposed on third world countries for 50 years, the effect is always the same. Not only is it economic shrinkage, but because it's shrinkage, because it causes, trying to repay the debt causes unemployment, impoverishes the economy, the debts actually grow instead of shrinking. And that's not a bug, that's the feature. They know it will happen. They deliberately falsify a fake picture. And if you don't agree, you send in the Marines, and quite frankly, you shoot the people who try to oppose this with the reality economics, as the United States did in Chile under Pinochet, when you had a government that tried to do that. So you're having, really, the creditor cartel is running world politics. And in that sense, what we're talking about is not simply a monetary theory, it's a political theory that is shaping the whole world, and that's the theory that's driving Russia, China, India, the whole Eurasia, out of the globalization orbit, because globalization basically means permanent depression for labor, financialization, and if you don't want to be part of this, you have to withdraw from the globalized order.
Any students want to ask a question?
How many of you have bank accounts? Everybody. All right. Credit unions? Mostly, okay.
Yeah.
Students, right, okay.
So how many have student debt? Yeah.
Oh, well, do you have to pay out your loans before you graduate?
No.
No, okay, so you don't have debt yet, right?
They have loans.
You have
Yeah,
loans.
they,
All right, okay. Any of you worried about that?
Silence.
All right.
They're not close enough to graduation
Yes,
yet.
sir.
This was the question, the comment for the student. When did we want?
Wait, he's getting a,
Frank?
Yeah, we
would you
can't
wait
hear.
for the- yeah.
You would have bought a house and a car and a debt like that. Well, if you imagine that over 30 years at 6%, it comes to being about 3 times the principal of what you end up paying. Now that's the same for your personal house as well as school buildings and any of these other infrastructure things. You're going to all pay it unless you change and go to one of these other schemes of the public banking scheme. Because if you did that, you'd be able to buy 3 elementary schools or 1 elementary school plus additional things. You see? So that's where it really has an impact on your life over the 30 or 40 years of your earning capacity. So it's trying to just bring it home to the students. That's what you're facing. But if you could get the money at 1 or 2%, which is what a public bank can do, because you own it, imagine what that turns out. You just do the compound interest formula for that. Makes a big difference, as well as where the money is actually invested in.
Yeah,
That you could control.
One example is a fellow who's running for governor in New Jersey who is now running on a public bank platform. Very interesting. That's a breakthrough for the common understanding or familiarity with the term public bank. But he likes to say, look, last year, New Jersey, by the way, is a very rich state, but it's very broke. It has like, you know, it's every average citizen there owes $56,000 in debt. Now, that is state debt. They're not going to pay it individually, but it's a horrible ratio. And so he's running on the idea that, look, last year we spent $1.5 billion building the roads and the bridges and the railways of the future. In Japan, us as New Jersey taxpayers, we're supporting another culture. Why? Because they gave their money to Wall Street. They put their money in TD Bank, which is $4 billion, in Bank of America, Wells Fargo. And these banks, of course, do what any good bank does, is go out and use that money and leverage it and turn it into profits. But they did it for themselves. New Jersey got $250,000 in 3 commercial loans from those banks last year. So this is this predicament that you're moving yourself into, and perhaps in the unconsciousness that we all have about money and banking, you'll just, you know, kind of let it go by. But we are all, and you will be we are all, and you will be paying it until we do something to stop that cycle. Sir, you had a question.
Yes. We're building a really strong case to public banking, and I was just wondering how did it happen that nowadays we actually use much more private banking, and the only example for public banking that we mentioned is the Bank of North Dakota. I'm just trying to understand maybe what are the positive sides, or was it all just a scam? That's why we got into private banking. You know, why did we shift towards private banking, basically?
There was a 100 years fight over what kind of banking system we'd have that ended in 1913. Until 1913, the Treasury did all of the functions that the Federal Reserve performs. On my website, I have an article on this. And the commercial bank said, we want to take monetary policy out of the hands of government. We want to move the focus of policy out of Washington into New York, into Wall Street. Street. And we don't even want the government people to be on the board of directors. We want to be in charge of creating the money. We want to give it to ourselves, and we want to give it to ourselves in a way that will make the rest of the population poorer and poorer so we can lord it over them. And that's the Federal Reserve. And there was a debate for 100 years. Henry Clay, Andrew Jackson, the Whigs were fighting against the Democrats all until the Civil War, wanting public banking. The Democrats were the slave power, and they said, no, if you have banking, you'll have government banking, you'll have industrial growth, and we don't want that because that will bid up the price of grain, and it'll make feeding slaves to produce cotton more expensive. So this whole argument went on for 100 years until, finally they got Woodrow Wilson in the White House and were able to convince him to relinquish government authority to the private banks.
I would add the whole central banking system came into existence, in 1912, before we set up our Federal Reserve in 1913, the Commonwealth Bank of Australia was set up on a different model where it was actually run by a banker. He knew how banking worked, and the bankers came to him and said, well, you're going to have to borrow from us, to get set up. And he said, no, I think we'll just issue the money. We'll just operate on issue the credit of the country, which is what they did. And they rebuilt the country, funded their participation in World War I, and did brilliantly well on this system. And then he, the head of the bank, made the mistake of going to the City of London and boasting that they no longer needed to borrow from the Bank of England. The City of London was pretty much, they had lost control of their colonies politically, but they still had financial control of the colonies because everybody basically had to borrow from the City of London. So he had a heart attack not too long after that, and they changed the model where they put a board in charge of the bank, and they had a conference where some big bankers got together, and they set up this whole central banking system where the Bank of England was supposed to be the head of this pyramid with all the other central banks below it, and the Bank of England would basically be the controlling the top of the pyramid. But after World War I, the UK was not financially strong enough to manage this themselves, so then 4 bankers formed the Bank for International Settlements, and that became basically the private head of the central banking system. I mean, they're called publicly owned central banks, but they're really privately controlled. They say they're independent, which means they're independent of government, but they're not independent of big banks. They're actually controlled by big banks. But so that's the system, particularly in the 1970s, when the dollar went off the gold standard, globally, when Nixon took the dollar off the gold standard, in order to maintain our power, the power of the dollar, Nixon and Kissinger made a deal with the OPEC countries that they would sell their oil only in dollars, and in return that the U.S. would protect them militarily, and what else did they do? I forgot. Anyway,
That's enough.
Yeah, so that system was set up until Saddam Hussein broke the deal, and we know what happened to him. And Libya broke the deal, and we've seen what happened to them. So anyway, you have a number of renegade countries that have attempted to step outside the central banking system. But in general, most banks are within this Bank for International Settlements and system of World Trade Organizations that are private. And yeah.
Yes, sir.
Where did the language of the national debt being a problem come from, and why?
What?
Where did the language of the national debt come from, and why?
Why is national debt a problem?
National debt isn't a problem because it doesn't have to be repaid. It's called a problem by politicians who want to shrink the economy, and they know that if you shrink the national debt, then the economy will either be impoverished or it will have to borrow more from the banks. So shrinking the national debt means don't depend on the government for money. Go to Citibank and the big banks for the money and pay them interest for it. Don't get money for free. Pay us.
That makes sense? You get it? Cool. Well, that's all right. It's a quiet bunch, but maybe they're just too shocked with what we've been saying. Yes.
Sure. So I had a quick question. I think one of the points earlier was public banks have been more profitable. So I wanted to ask where that profit came from, given lower margins. And also, I wanted to ask what the model would be for a public banking system, what central bank's role would be, like how would it look like if you were to take maybe U.S. as a case scenario for it?
Sorry, if you were to what?
If you were to take the U.S. as a case scenario for this model, how would it look?
Okay, so where do they get their profits from? They have much lower costs, so they don't have to have branches everywhere. They don't pay $20 million to their CEO. They pay, I think, $280,000 or so. That's their highest paid person is the president of the bank. They don't have private shareholders. So all those costs I listed before, they don't have to advertise. They're basically partner with the local banks, so the local bank does most of the local dealing with the customer, and it has all those costs. And the Bank of North Dakota is able to leverage their own funds, or the funds of the state. So they do like all banks do, which is to borrow very cheaply. In effect, they're borrowing the deposits or the revenues of the government itself, and to lend at a bit more. So if you're borrowing at 1%, you can still make 2% loans times 9. If you've got a capital base of, let's say, in California, let's say you had a capital base of $1 billion, you could make, and you held back 10% for your reserve requirement, you could still make 9 times 2 is 18%, even if you're lending at 2%, and you could still pay a decent return on capital, and you'd still make a profit, and you're lending very cheaply to your community.
Yeah, I would just, one of our colleagues did a study of, he's a banker, and he said, well, what does it cost them to do business at the Bank of North Dakota? And how does it compare with, let's say, Bank of America? So the amount of interest that they have to charge when they make a loan to cover their nut is 0.6%. Bank of America, their nut is 6.1%. So it's 10 times greater. And so you see they're in a much different business, and of course they're extracting a great deal more out of their customers. The public bank, the model that we propose is a commercial vehicle, a commercial institution. It needs to make a profit to sustain itself, but it doesn't have to make a killing. It needs to simply keep the money rotating and make smart loans, make loans that are lower in risk, and they certainly are statistically at BND. And of course, you are a little safer by lending to yourself anyway. So if you're lending to your municipalities or your citizens, and you know where they live, and you know what they've got, then that's a much safer sort of a banking model to environment to work in. And that's even true for commercial banks in that state. Their risks are also, they share the risk with the public bank as necessary. Yeah.
Okay, and then on what a central banking system, what I would envision, the ideal central banking system, but first of all, you want to get control of it. We need to actually be serving the public and not serving the banks. The Bank of England and other banks are now talking about issuing their own central bank digital currency on a blockchain model, rather like Bitcoin. And opening up their deposit window so that everyone could have a deposit at the central bank. So if everyone, and everyone would want to deposit with the central bank because it would be safer. There wouldn't be bank runs. You don't have to worry about booms and busts and bail-ins and bailouts and so forth. And the issue then was, where would the private banks get the liquidity if they don't have deposits anymore? How would they be able to make loans? But it seems to me the obvious answer is open your lending window as well. If the central bank also made loans to individuals, I mean, you might say, well, that's too much business for the central bank to deal with. But you could do all that on a blockchain model. That you'd be virtually banking with yourself. It's like banking in the cloud. Or you could, as an intermediate stage, you'd have public banks, let's say, that are dealing with you on a local level. But the public bank would be more of an agent of the central bank rather than being a private institution. That's, you know what I mean? They're actually borrowing from the central bank, which is this great bottomless pit of liquidity.
Anybody else back here?
In the back, we have a couple of up front here.
I'm going to go out on a limb and assume that there are at least 1 or 2 students in the room here tonight who hope to become filthy rich when they are not even my age. And it seems to me that what you're proposing is to eliminate a sector of the economy, or at least to severely downsize a sector of the economy, which offers the opportunity to educated individuals to become filthy rich. This sounds like a conspiracy against America to me.
Michael,
what's your reaction to that?
The question is, how are you going to be rich? Are you going to be rich by adding to the economy's output and employment and making the economy richer, or are you going to get rich by making the economy poorer? The financialization model means that you get rich by making the economy poor. China and other countries have been able to avoid that model, and you see why they're expanding and why we're not.
But you do admit that this will limit the opportunities for people in the United States to become filthy rich, right?
Necessarily. They can become rich doing something beside banking. If you channel them into banking, it's going to be a blind alley, and they're going to find that they're not very well paid, that unless they have, this is a family business, unless you have relatives in it, and unless you will start with a lot of money, you're not going to be able to get much money. Although, when I went to work in Wall Street 50 years ago, Wall Street said there were 2 sources that they were looking for officers. One was a Brooklyn slums, and the other was the Hong Kong slums. They wanted people so poor that all they cared about was trying to get rich, and they didn't care how they did it. Is that the way that you want the country to get rich?
I don't actually remember the figures on this, but I think the Japanese model is something like that the richest are 7 times richer than the poorest in a business or whatever, and we have a much larger spread. So it's all relative. If richness to you is to make it to that 7th rung, it seems, why do people want more than they can possibly spend? It's a power thing rather than a money thing, and we need to change our consciousness, or what we really want out of life. We need to change our value system. The best things in life, obviously, are not things you can buy with money, and maybe people that want all that money are people that don't have those things, the more personal relationships, that kind of stuff. So anyway, it seems to me we have to think in terms of the richness of life is not about money.
Yeah, it's a really good question, and I think the answer is no, we're not going to be able to put Wall Street out of business, and that's not really the intent. We would like to be able to coexist with Wall Street in a way that the public interest isn't sacrificed for the profiteers and the profiteering of that industry. What we've seen in recent years is scandalous, both in terms of how they operate their business, but what has happened to the American populace, to our fellow citizens have been raked over the coals and have lost their position, lost their jobs, homes, and prospects. So we need to we need to create a new opportunity here. And I think that, as Ellen indicated, this is a time for us to, for you all especially, to look at the prospect of creating a new paradigm. For what does it mean to be a human and a citizen? Do you define yourself just by what's in your zeros or what's in your driveway? You can have nice something in the driveway and have a public bank. We're basically saying, look, to Wall Street, look, you guys go have fun with that. You're doing great. Have a great time with that. Just don't do it with our money, okay? The public has a right to control and to use its own money for its own interest. We don't need to hand it over to them. Yes, sir.
Is public banking impervious to corruption? Because, like, looking back to the 1800s, I was just doing some quick research. Most of America was public banking at that time, and they all failed miserably. Usually fall into corruption.
I don't think they were public banks. There were a few public banks, very few.
But they were way more common.
You're right.
Today.
It is open to corruption, and you have to be very careful to avoid checks and balances that way.
That's why you want a system and a blockchain model, because it's not corrupt.
Yeah, and then do you think North Dakota is kind of a interesting setting for, because it's so different than most of mainstream America. I mean, it's a pretty homogenous society, really focusing on fossil fuel industry. Do you think that is a good thing to base?
But maybe arguably they're not corrupt because they have this public bank, which it's audited several different ways, and the model itself is, they're civil servants just doing their job. There's no motive for speculating, or they don't get anything special for making deals. So they're just doing a job, and the state itself has its own funding mechanism, so they don't have to grovel before big business or big money.
The Ukrainian bank is a public bank. It's the most corrupt bank in the world, which is why George Soros and the neoliberals love it. That's the model. We want a corrupt bank. They say, as long as you can have a public bank, as long as we can create it and give all the money to ourselves. So of course that's the problem, and you have to be very careful against the crooks who are trying to do that. Just like in the movies, the small Hollywood movies in the 30s, a small town, there'd always be a crooked banker working with the saloon owner and the land speculator, always giving loans to get the politicians to build a road by their house to make their property more expensive. That's
don't you think that in the long run, let's say you start a massive public bank in New York City or something, don't you think it would eventually just run into the same problems that,
I just think that in the 21st century, we have new tools that we never had before for transparency, for accountability, and for preventing fractional reserve, multiplying, using the same money over and over, like rehypothecation of collateral, et cetera. You can see exactly where the thing went. And so you can't.
You may have to actually throw them in jail, which is what Obama didn't do. So you need a president that doesn't work for Wall Street and is not a demagogue. You have to have a real president.
Yeah, but I don't think we should even put all our, we've seen we put our hopes in one president after another, and it never seems to work out. We, the people, have to do it ourselves. We need a movement. We need to understand what's going on. It can be leaderless. It's better if it's leaderless, where we're all just, it's just the grass moving in the same direction, grassroots.
And so I guess we'll have to wrap it up, but I would like to add to your question. One of the challenges that we have at the Public Banking Institute is to articulate or to design the architecture of separation between how the bank operates and who owns the bank. And that's something we're spending a lot of time on, and North Dakota's done it very successfully for 97 years. Thank you so much, one and all, for this.
Thank you very much.
As it was in 2008. Yeah, The Big Short was the name of that movie. Have you seen that movie?
Yes.
Have you seen it? Yeah. Another really good movie about Wall Street is Margin Call.
Oh yeah, that's good too.
They really are.
Yeah, they are.